One thing that we hear a lot about in terms of bond valuation is the term structure of interest rates. The term structure, or the yield curve, can be found by opening the Wall Street Journal any day. And there's a graph that they present in section C, which details the yields to maturity for bonds of different maturities. So it's a graph where the y-axis presents the yields and the x-axis presents the time to maturity. And if the short-term yields are lower than the long-term yields, as they are most of the time, then this graph is upward sloping. And the so-called term structure of interest rates has a positive slope, or the term structure or the yield curve is positively sloped. If the yields are identical, no matter what the maturity, we say the term structure is flat. This is actually an extremely rare event. And it's actually the case that it's almost never the situation where interest rates of all maturities are equal. There's also a situation where the term structure could be inverted, which means that the short-term interest rates are actually higher than the long-term interest rates. Final possibility, and there's actually many possible outcomes for the term structure, is a so-called humped term structure. And this means that the short-term interest rates are low, the medium-term interest rates are higher, and the longer-term interest rates are lower. So we get a hump-like shape in the term structure. Now, one immediate question is, what does all this mean, and why do we care about the term structure? Well, it turns out that later on, the term structure is very important for evaluating a project, evaluating the price of really any security. We need to know what the interest rates are for different maturities if our security has a life of more than 1 year. So this term structure is quite important. And the question is, what determines the term structure? And this is very much related to the question of what determines interest rates. So one of the examples that I used earlier on was this example of people expecting a recession, let's say 1 year from now. And to hedge against this possibility, people would buy, let's say, a 1-year bond. Okay? As people bought the 1-year bond, the price of that bond would go up, and the interest rate associated with it must go down. Now suppose that people, when they were doing this, were liquidating their very short-term investments. So let's say 30 or 60 or 90-day treasury bills. So they were selling these to buy the longer-term 1-year bonds or 2-year bonds. Well, if enough people are actually doing this, and if enough people expect a recession next year, then the act of selling these 90-day treasury bills will actually drive the price down and the interest rates up. So you have two simultaneous things going on. People are buying the 1-year bond, the price is going up, the interest rate down, and people are selling the 90-day treasury bill, the price is going down, the interest rate is going up. Now what's going to happen to the term structure here? Suppose we started out and the interest rate on the 90-day treasury bill exactly equaled the interest rate on the 1-year bond. Well, this buying of the 1-year and selling of the 90-day is going to cause the interest rates on the 90-day to go higher than the interest rates on the 1-year. What we're going to see today is the term structure becoming inverted, where the short-term rates go above the long-term rates. Now, it's rather interesting that if people expect a recession, that this sort of phenomena would occur. It's interesting because if you look at the last 5 recessions, 1 year before each one of these recessions, the term structure inverted. It was the case that the short-term interest rates went above the long-term interest rates. It's also interesting that at no other point in the last 5 years did the interest rate term structure invert, other than before recessions. So the term structure of interest rates is rather interesting in that it gives us a view of what will happen in the economy in the future. And it seems to me, according to my research, that the overwhelming influence on the shape of the term structure of interest rates is the expectation of what will happen in terms of the business cycle. This is very important. It shapes the term structure, and if you examine some of the graphs that I have available on the World Wide Web, you can explore the term structure through time, and you will see the inversions that occur before the recessions in the last 5 business cycles. Now, there's a number of theories of the term structure, and they are very much related to the theories of the interest rates that I mentioned. The overwhelming factor that I found in determining the shape of the term structure is the business cycle itself. As with interest rates, expected inflation is also very important in determining the shape of the term structure. So if people expect high inflation in the short term, but low inflation in the longer term, then this will cause perhaps short-term interest rates to be higher than longer-term interest rates. And this was definitely the case in terms of what happened in 1979 and 1978, where short-term interest rates were very high because the expectations of inflation were quite high over the short term, but the longer-term interest rates were a lot less. Now, you should also remember the third component that I mentioned. That was the correlation between inflation and the business cycle. It's often the case that when inflation is high, that the economy is very weak. So this correlation is also very important. So it turns out in 1978 and 79, when expected inflation was high, it was also the case that the economy was about to become very weak, and we entered into a recession. There are a number of traditional theories of the term structure. Theories such as the expectation hypothesis, the market segmentation hypothesis, the preferred habitat hypothesis. These are all traditional theories of interest rates that have some merit and can really be folded. A lot of these theories can be folded into the simple theory that I suggested based upon the business cycle and expected inflation. It's not necessarily the case that these theories exactly hold. For example, the expectation hypothesis simply states that the long-term interest rate, let's say the 2-year interest rate, is a forecast of what the interest rate will be, the 1-year interest rate will be 1 year from now. It turns out that that is a highly simplified theory, and it's not necessarily the case that this will actually occur, because it depends upon the economy, it depends upon expected inflation. It's also not necessarily the case that there's a market segmentation where certain investors prefer certain maturities. It turns out that that theory is extremely difficult to test, as is the preferred habitat theory, where investors again prefer certain maturities. These are theories, but extremely difficult to test in terms of the empirical work.